Why are the markets fretting? There are many who believe a slowdown-based recession is the likely outcome. Now, given that there are escalating geopolitical uncertainties, there is flaring Omicron cases-based lockdown in China. There are rising crude oil prices, there is a clogged supply chain coupled with high demand scenarios. US stocks are melting. Investors are taking their money out. Startups are getting repriced, and there are elevated interest rates by most of the central banks across the board. So you may ask, what is good about the markets? Could the markets fall further? Every assumption, every thesis that FY23 will be better than FY22 is getting challenged as earnings are getting downgraded. What is the truth and how worried should you be? Should you sit on cash and wait for better entry points, or should you put your money, whatever you have as a surplus, to work in the markets, as the metaphor is that this market seems like a big sale? This episode covers everything that is there to the situation today as the markets see a deeper correction with every passing session. All the answers are neatly tucked in for you. You're watching a special episode of Informed Investor, our initiative by Research and Ranking. Let's begin. First of all, why are we seeing the markets fret? Remember, we have been saying that there will be a quantitative tightening by most of the central banks, including the US Fed, as the inflationary concerns are real and the numbers speak for themselves. Now look at US. It has not seen inflation in the range that it experiences today of 8.3% for a long time. On May 12th, the inflation data came in for India, and it pointed towards a worse than expected inflation number of 7.79% for April. In this, food inflation jumped to 8.38% from 7.68% of March. So we knew what was coming. Maybe the severity of what has come has surprised us. The inflation data, as an example, which has been higher than the estimates given by the economic advisors and market gurus. But otherwise, nothing was hidden or was a surprise for anyone. Then why are the markets behaving as if there is not much of a positive news around the corner, at least in the short to medium term? We are using the term fretting for the markets. See the chart that appears on your screen now. 55% of the Nifty 500 companies have seen a decline of 26 to 50% from their 52-week highs. The NSE set of stocks as high as 14% and as many as 259 have seen corrections in the range of 51 to 90% from their 52-week highs. Now see the second chart that appears on your screen now. The breadth of the correction is not limited to the lesser known names. As a matter of fact, marquee names such as HDFC Limited, Tata Elxsi have fallen by 27% from their 52-week highs. A business such as Nazara Technologies has fallen by as much as 68%, keeping the same parameter of 52-week high corrections. The rout in Nifty mid-cap and Nifty small caps can be seen in the relative comparator charts that shows the rout on all the three indices, with Nifty correcting as much as 14% from its peak levels. The correction is even more brutal for Nifty small cap index. Why is the scale of correction seeming so brutal and widespread this time? Can this be termed as a knee-jerk reaction by the markets, or there is a logic behind these widespread deep corrections? Firstly, remember, markets are wiser than us. This is not a bear market. This is still a bull market, and this is a typical bull market correction that is taking place. Understand the fact that recession and depression are two different terms. Recession, by definition, is technically speaking two consecutive quarters of economic decline as reflected by the GDP in conjunction with monthly indicators such as the rise in unemployment. Depression. A depression is a severe and prolonged downturn in economic activity. In economics, a depression is commonly defined as an extreme recession that lasts 3 or more years, or which leads to a decline in real gross domestic product of at least 10% in a given year. It is for sure that we are not looking at a depression as some of the WhatsApp messages and sensational social media videos are making it seem. The financial apocalypse, not at all. But is it possible in technical terms that India would enter a technical recession when it sees 2 consecutive quarters of GDP decline? Again, technically speaking, yes, it could. But the more appropriate term or a definition is a slowdown in the economic growth. Now let's come back to the burning cause of concern, inflation. As for the US, inflation is of 8.3% and is near 40 years high mark and is surely higher than in India. But let's come to the point on why the markets are sending the red beacon signals. The first is the Russia-Ukraine situation at hand. Honestly, no one can predict whether the stalemate will continue or we will see further escalation of the situation. The second is the bond rout that is happening globally. Interestingly, the developed markets have seen significantly higher inflation numbers. The emerging market banks had started to take steps much earlier. Keep in mind that the stimulus in the developed nations context was way higher. In addition to this, there were many capital burning companies that were riding very high valuations in countries like the US, which have seen the deepest corrections. The third, amongst many reasons, is related to the demand side that looks healthy, but the supply chain constraints apply. Hence, the rise in supply led inflation, especially given that Shanghai is putting in effect a zero COVID cases policy, taking extreme measures of locking up citizens in buildings even if there is one stray case of a COVID infection that is detected in a building. The world factory, as China is called, has come to standstill with ports clogging up, the containers awaiting, the clearances which are already strained. So, the next question that arises, seeing the genesis of the market corrections, on the back of inflationary concerns, should we be worried or alarmed about the RBI raising its interest rates? Well, there is nothing to be alarmed about. In fact, we should welcome this on various fronts. We have a very strong economic recovery in the country, and hence inflation will keep peeping up every now and then. And this rate hike of 40 bips may not be able to halt the hike in inflation. Hence, the sooner the better by RBI, as one would say. The economic recovery is well backed this time, and hence the basic premise of an interest rate hike stifling the GDP growth for a country like India can be said to be a little premature on the part of many agencies who have cut the GDP growth estimates on the back of interest rate hikes. The markets may well be said to be fairly valued to being slightly undervalued as on date. The fact is that the earnings will still see a double or a near double-digit growth on an aggregate basis in FY 2023 and FY 2024 ahead. Most of the people watching this episode have joined the markets in the last 2 years. The post-first wave COVID investors, as I may call it. Now, with the past 3 to 5 months of lackluster and rough ride of the markets, people have started to ask, is the rest of 2022 going to look like this? It's like saying that you've been cruising at 100, 120 kilometers per hour on an expressway, and suddenly you have hit a patch of the road that has many potholes, and your speed has come down to 5 to 10 kilometers per hour. So essentially, the question that you are asking is, will the rough market patch continue? For a seasoned investor, the last 3 to 5 months are nothing different. These cycles have been seen umpteen number of times, repeatedly. But for a new investor, at least the ones who joined in the past 2 years, the markets seem very cruel in the past 3 to 5 months. There is a wise lesson on the markets that we've been sharing with all the clients repeatedly. All years are not the same. As per the 4 focus areas, there are special episodes that we've shot on this. I'll urge you to go and see it. This year is for sure not the same as 2020 or 2021, and may well end up being a year which is tough and tests the patience of many investors. This may well be the theme for the next 5 to 6 months till the US markets find a bottom. So strap yourself for some choppy periods ahead, as this will take time to come back. I don't think you can simply say that this will get over by the next month. This will need some time. During this time, the commodity prices will need to cool down significantly. Headline inflation imprints will have to moderate. At this stage, the trends in inflation have just started to worsen. And for them to moderate on a sequential basis, let's say quarter on quarter or half yearly basis or year on year basis, we will need to give it some time. So we'll have to traverse a few months down the road for the data to look optically better. We will need to set this one out. Regardless of the volatility and the uncertainties, the fact is that there will be companies during the times of 6 to 7% inflation periods and a series of interest rate hikes that will not be able to generate free cash flows, and hence will face the heat and will continue to be dropped like a pack of hot potatoes. On the other hand, companies that are fundamentally very, very strong, have return on capital way higher than the cost of capital, will emerge as wealth creators for you. There are companies that will need to be earmarked during times of these corrections, as they present a deep bargain price. Remember, these companies have a phenomenal strength of pricing power during times of rising raw material inflationary pressures. These fundamentally sound companies can outperform the indices by a fair margin of 10-15%. Over a period of 3 to 5 years, these companies will end up creating wealth for the shareholders. As for the environment, the demand is high while the supply side of the equation seems to be constrained. Hence, the question of inflation and rising interest rates will continue to be the topic of many episodes, like this one that you're watching today. Many people keep calling us and ask us questions such as, is the longevity of the bull run, as the one we saw for the past 18 to 20 months, at stake? Is the market in for a bear phase? Well, first things first, the genesis of a bull market trigger is always in a bear market like situation. What do I mean? Well, taking the US context, today, look at some of the US giants. Companies like Apple, Google, Microsoft, Facebook. These companies are available to pick 15 to 30 times 1 year forward earnings. These all names have corrected significantly in terms of valuation. New age companies like Tesla, they've corrected while their earnings have picked up. So it's not that there are no companies to pick in these market situations. There will be companies which are decently placed in terms of valuations and are doing well with earnings too. These are the companies where the so-called bull market phases will kick in as the uncertainties we discussed earlier start to fade away. You will see the wealth creation impact 2, 3, 5 years down the line. This is the period that will give you the foundations for the next bull market for sure. For sure, you will find stocks that are not falling that much, in fact, are beating the markets because they are fundamentally strong and are delivering numbers consistently. These stocks need to make your portfolio. These businesses will last for more than 3, 5 years plus and will create wealth for you. On the other hand, there are companies where the valuations are not backed by the earnings, and the growth prospects come studded with questions ahead, especially with the consistency of generating cash flows year after year. These companies may well see periods of so-called bear phases going ahead. This is not a market where you can carpet bomb, but a market where you must be ultra smart in picking names that will compound your wealth over the next 3 to 5 years of time. The mistake that seasoned and novice investors make is that they sell the winners and back the losers, which have corrected by 40, 60, 70%, hoping that the losers will be able to come back to the buying price, at least, and recover all the losses. This is a typical mistake that all of us make. This is a time to pick the fundamentally tested businesses that can weather the storm and come out with probably a scratch on the body, as opposed to many of the mid caps and small caps that are on the lack of fundamental strength may end up being in the ICU. So clearly, this is not the market of 2020 or 2021, where everything and anything worked. This is a market of divided beliefs. Some who will end up making a lot of returns over the next 3 to 5 years, and then there are others who will see the brighter side of these times, but only at a later stage. At the same time, let's also be practical. Let's also be practical in stating, and in as many terms, that events will shape the markets. And no one can be certain as to the way the markets will turn from here, at least in the short term. The markets may well correct further by 5% or more, given that they have corrected already by 14% from the peaks that it achieved. Example, Nifty at 18,604 levels. No one can accurately predict the turn that the markets will take from here, as there are events that can play out and bring a surprise from everyone. A classical paradigm of conflicting events can be, if you look at the employment data and the inflation data in the US, then the interest rates need to go up than what is being discounted by the markets. But if you look at the GDP numbers in the US, which declined at a minus 1.4% pace in the first quarter, below analyst expectations of a 1% gain, and if we extrapolate the negative growth for, let's say, a few more quarters, then we will be left scratching our heads. Scratching our heads if the Fed will continue to raise the interest rates. On the crude oil situation, the prices may well go upwards depending on the escalation of the war between Russia and Ukraine. Or the oil prices may well come down drastically if the Iranian oil starts to flood the global markets. In situations like these, one needs to wait and be a little more patient before taking a decision to pack the bags and scoot away by selling the holdings altogether. What can be said about the growth prospects ahead for a country like India, considering the phase where we are? We as Indians have weathered and continue to weather the crude oil storm better than anyone else. India meets nearly 80% of its oil needs through imports, and rising crude oil prices push up the country's trade and current account deficit while also hurting the rupee and fueling the imported inflation. Despite crude being at $100 a barrel, yesterday it was 106, and despite India being a big consumer of oil, there is a fair insulation that India has been able to build to these shocks. Come to realize that India's software exports are USD 250 billion a year, which is more than what Saudi Arabia makes by exporting oil. By the way, Saudi Arabia's company has become the most priced company, Aramco. It's valued at 2.46 trillion and Apple is valued at about 2.38 trillion. It just became the number one yesterday. So, our Forex cushion today is way better than what it was in yesteryears. We've all seen the relentless selling by the FIIs this time, but the markets have been well supported by the DIIs. There are 10,000 to 12,000 crore SIPs coming into the markets every month. India as an economy and as a growth story is expected to grow at 6 to 7%. Maybe 50 basis points here and there, but this is still a very healthy number. While the world seems to be in a slowdown phase, the structural growth drivers for India look more impressive than ever. These structural growth drivers will further boost the India Inc.'s earnings in double digits for the next 5 to 7 years. First, the global push towards digitization, especially post-COVID, wherein India is a leader in exporting software solutions, servicing, coding, the stuff like that, and is actually going to be a very, very big driver. Second, China plus one policy of exploring other options to manufacturing at a fraction of a cost with less ambiguity and interference from the governments is forcing global companies to look elsewhere and explore countries like Bangladesh, Vietnam, and certainly India, where skill sets are available in abundance. The proof to this is the way our exports are growing. When was the last time you heard our exports grow at 20 to 25% for a longer period of time? There was an episode done by my colleague Raj Mehta on exports. I would urge you to go and see that. It is going to leave you spellbound. Third, long-term reforms and policies like corporate taxation reforms, investments in the infrastructure, PLI driven by a committed, democratically elected government that is stable at the center is a major factor for crafting the long-term prospects. And finally, the fourth structural lever, the rising per capita income and middle class aspirations that are very fundamental to the growth prospects ahead of a country, where the consumption is expected to grow leaps and bounds, especially after crossing the $2,000 per capita income mark. There will always be two sides to the same tale, one positive and the other skeptical, not so positive. The data and experience from the past periods reflect something else. You have to listen to this. Like the period FY 2004, FY 2007, when we had seen the interest rate hikes across by the Fed, by the RBI, to the tune of 200 to 250 basis points. Keep in mind that this neither stopped the economic recovery nor the bull market that resulted. So there will be the hot topic that will continue to give you sleepless nights and will force you to look at safer havens. But the wiser few informed investors will look for bottom-up opportunities, and believe us when we say that there are many that are now opening for you. If you're selective in your stock picking approach and have an outlook of holding these wealth compounders for at least the next 3 to 5 years, there are many opportunities that have opened up. As for the year 2022, keep in mind, all years are not alike. So if you've seen returns like 2020, 2021, where everything you touched seemed to be a scream buy and indeed gave you good returns, this time you must be cautious. This time you must be a bottom-up investor, knowing that there are great businesses that are now going to be available at attractive valuations. As for R&R, these opportunities will find way into the portfolios you hold. As the days go by, where we see valuations supporting our stance, if you are an existing subscriber, you will get these opportunities. As for the people who've not experienced the balanced portfolios that make the best of the valuations blend, there is always a start that you can make. As a matter of fact, today. So here's wishing you and your loved ones a great health and happy investing ahead. Till we meet again, this is Sanjeev Anand signing off. Take care.